Hello and welcome to KBRA Clips. I'm Kate Kennedy and I head our media relations efforts, and I'm joined today by Brian Ford, head of structured finance research at KBRA. Welcome, Brian.
Thanks for having me, Kate.
So today we're going to talk about the European Structured Finance Conference that took place in Barcelona, June 5th through 7th. Both Brian and I attended, along with a number of other colleagues from our New York and Dublin office. Our Dublin office we opened in September of 2017 and have really grown in the European structured finance market since then. We've hired roughly 10 employees in our Dublin office and rated our first European structured finance transaction in April of this year, which is brought to the market by Funding Circle, the S-Bolt 2018-1 deal. So we're looking forward to expanding in that market, and during the conference, Brian put out a number of daily recaps from each of the days, which highlighted the trends that we were hearing at the conference, and many people commented on them, and we're here today to just kind of recap on those trends. So Brian, with that, perhaps you could just give us a high-level recap of what happened at the conference and anything that would be of interest to listeners.
Sure. Yeah, so I think what made this conference so interesting was that it was occurring in Barcelona during a week where there was a ton of heightened political uncertainty in Europe. I mean, take your pick. You had a new government in Italy laying out a Eurosceptic agenda. You had renewed calls for Catalonian independence from Spain. You had the ECB coming out with more hawkish commentary on their timeline for ending quantitative easing. The U.S. imposing tariffs, and wrap that all up with a pretty tumultuous G7 summit. So there was definitely a lot of focus at the conference on really the macro level. I think because of all the macro volatility going on last week, there was a lot of discussion on portfolio positioning and where spreads would go for the remainder of the year. At a high level, most of the investors we spoke to really had mixed views, but I think there was a tilt toward spreads widening by the end of the year, just given all of the political uncertainty across the EU, as well as technical factors such as the EU or ECB ending its net asset purchase program. In terms of portfolio positioning, I think most investors agreed that shortening duration and moving up in credit was a prudent play at this point, given the current environment. Just given where the flatness of the yield curve, making shorter dated paper relatively more attractive, and moving up in credit just to kind of protect your downside risk, given volatility continues to pick up. Outside of the capital markets topics, there was certainly a lot of discussion on the regulatory front. It was interesting coming from the U.S., where Dodd-Frank has already been implemented and actually now even being rolled back by the Trump administration. In Europe, most of this regulation is just now coming into effect or coming into effect next year. So it was certainly at the front of conference goers' minds last week. I think the regulation that was most talked about was STS, which stands for Simple, Transparent, and Standardized, which was just because it really has implications across all the structured finance market.
Good. So thanks for the abbreviation meaning. But so for those of us that don't know, what exactly is STS, though?
Sure. So, the European Council has really been focused on having a highly liquid and healthy securitization market, just because it's so important to the economy. It helps to fund consumer loans, mortgages, loans to small businesses. So as a result, they've enacted a number of regulations to really promote the securitization market. I think the most important and wide sweeping is this STS regulation. And really what that is if a security meets a number of different criteria. There's about 80 criteria that it has to meet. It's eligible for STS. And that criteria has to do with due diligence, transparency, certain risk retention requirements. But if a security meets all of those criteria, it's treated more favorably from a capital perspective. So banks and investment firms have to hold less capital on their books against an STS securitization versus a non-STS securitization. And so this reduction in capital charge really brings securitizations back in line with covered bonds, which really should help drive demand in European securitized credit going forward.
So you think that if there is demand within the European securitization market, that the supply is there?
Yeah, I mean, that's a good question. I think what we do know is that the ECB will end its net asset purchase program and its other quantitative easing programs either later this year or early next year. That, in addition to the BOE ending its term funding scheme earlier this year, really is ending a pretty extraordinary period of expansionary monetary policy in Europe. Because of that policy, banks have been able to get very cheap and medium-term funding from central banks for a number of years now. And as a result, they haven't had to tap the securitization market for their funding. You know, with the central banks now kind of taking a step back, I think banks are going to really need to get back into the securitization market to keep their funding needs afloat. So, with that, we should see an increase in securitized supply over the next few years. I don't think it's going to be any kind of tidal wave of issuance, but certainly we should see year-over-year incremental growth in the European market. So really, with the implementation of STS and tighter monetary policy from the ECB and BOE, this really could be the spark that really rejuvenates the European securitized market, which has been pretty dormant for the last few years.
It's great to hear. So do you think there's a specific sector that will take off quicker than another?
Yeah, I think the most likely sector to see substantial growth would be RMBS. That's historically been the largest securitized asset class in Europe and is primarily issued by banks. And again, banks have had easy access to capital from their central banks, so haven't had a need to securitize. Now that that's going away, they'll likely be securitizing at least a portion of their mortgage originations going forward. Another asset class that I could see growth in is fintech lending, both to consumer and to small businesses. You've seen the open banking regulation, which really puts banks and fintech originators on a level playing field in terms of the bank data they're able to use for underwriting. And you have similar regulation on the continent as well. So I think these together really could start sparking, this marketplace lending, which we've seen very strong growth in the U.S., I think that could start occurring in both the U.K. and on the European continent as well.
And you probably saw, at least I saw, that there was a little bit of an increase in the attendees also that were more fintech focused.
Absolutely, and really an increase in attendees overall. I think this was a post-crisis record for this conference. There were about 4,000 attendees, mostly from Europe, but you also saw a lot of investors from the U.S. attending as well. And I think as this market grows, it's going to garner more interest from U.S. investors, and I think European asset managers are going to start increasing their allocation to the sector, just given the amount of supply and favorable capital treatment that they're going to get.
Perfect. Yeah, and KBRA as a company attended last year, and it was actually definitely, you could see more of a positive trend across the conference this year versus last year. So we're excited to be part of it. So thanks for joining, and again, you can find Brian's daily recaps on our website, kbra.com, and you can also find all of our other European structured finance research as well. Thanks again.